New York City just changed the co-op rules. And if you're planning on buying a co-op in this city, or if you're in the middle of buying one right now, you need to know about this before July 28th. For decades, buying a co-op in New York City meant entering a black hole. You submitted your application and then you waited, sometimes for weeks, sometimes for months, with no confirmation from the board that they even received it. No timeline for a decision, no explanation if they said no. And in the meantime, your mortgage rate lock was ticking. Your moving plans were on hold, and there's absolutely nothing that you could do about it. But that era is ending. On January 29th of this year, my birthday, New York City enacted Local Law 58 of 2026, the Cooperative Application Timeline Law that goes into effect July 28th, 2026. This is the first time in New York City history that co-op boards have been given a mandatory, enforceable deadline for reviewing buyer applications. I'm Nicole Hamilton. I'm a mortgage broker in New York, specializing in first-time home buyers. In the next few minutes, I'm going to break down exactly what changed and what it means for you as a buyer, and how the board approval process actually works now that the rules have changed. Let's get into it. To understand why this law matters, you need to understand what the old system looked like. New York City has more co-ops than any other city in the country. Over 6,800 buildings, roughly 450,000 units. About 70% of apartments for sale in Manhattan are co-ops. And for most of that history, co-op boards operated with almost total discretion. They could review your application whenever they felt like it. They could take as long as they wanted. They could say no without telling you why. The City Council passed this bill 46-2 in December 2025. Mayor Adams vetoed it December 31st, and the City Council overrode that veto on January 29th, 2026. That tells you how badly people wanted things to change. Here's exactly what the law requires. Step 1, the 15-day window. Within 15 days of receiving your application, the co-op board or its managing agent must send you written confirmation by email and registered mail. That confirmation must tell you, is your application complete? If not, what exactly is missing? But here's the part with teeth. If they don't send that confirmation within 15 days, your application is automatically deemed complete by law, regardless of whether the board has actually looked at it. Step 2, the 45-day decision window. Once your application is complete, the board has 45 days to tell you in writing approved, conditionally approved, or denied. They get one extension, 14 days, without needing your consent. Any further delay requires your written agreement. If they miss the 45-day deadline, it doesn't mean you automatically get the apartment, but it does mean that the board faces fines, $1,000 for the first violation, $1,500 for the second, and $2,000 for each additional violation. Enforced by HPD. So these are real penalties. For the first time in New York City history, co-op boards are on the clock. Here's why this directly affects your mortgage and why I care about it as your lender. When I issue you a mortgage commitment, your interest rate is locked for a specific period, typically 45 to 60 days. Under the old system, a co-op board could sit on your application for 3 months. It made it incredibly hard to time the lock of your rate. If your lock expires because of co-op delays, you either have to pay to extend it, which costs money, or you lose the rate entirely and have to start over at whatever the rate is that day. I have seen deals fall apart because of this. Not because of the buyer's finances, not because of the apartment, but because timing is completely outside of the buyer's control. The new law bounds that uncertainty. A board has a maximum of roughly 60 days, 45 days plus one extension to give you an answer. That's still not fast, but it's a defined window, and a defined window is something that I can plan around when I structure your financing. Now let's talk about what goes into the board package, because the new law changes the timeline. It does not change what boards are looking for, and what they're looking for has gotten stricter over the years. Here's what's in a standard co-op board package: 2 to 3 years of tax returns, bank statements, pay stubs and employment verification, personal and professional reference letters, a cover letter, which matters more than most buyers realize, and the financial ratios that the board will scrutinize. Debt to income ratio, a DTI that may have worked in some co-op buildings a few years ago, say 30 to 35%, may not be as strong today. In the current market, some boards want something closer to 20 to 25%. You can still find co-ops with much more lenient requirements. Post-closing liquidity. This is the one that surprises buyers most. It's not enough to have the down payment, because many co-ops now require you to have 20 to 24 months of mortgage and maintenance payments sitting in liquid assets after you close. On an $850,000 co-op with a $680,000 mortgage and a $2,000 a month maintenance, you might need $75,000 to $150,000 in reserves on top of your down payment. Sometimes co-ops allow retirement funds to be used in reserve calculations, or I've seen a lot of cases where they say they don't count them, but if your overall profile is desirable, then it does not cause an issue. This is why people get surprised. They have a down payment and they qualify for the mortgage, and then the board says no, because post-closing liquidity is something that they didn't know about. So what I do is I walk every buyer through these ratios before they make an offer, and we make a strategy when presenting your financial information to make your offer as strong as possible, because finding out that you don't meet the building's financial requirements after you're in contract is a very unpleasant surprise. Now let's talk about the interview. The board interview is the part that scares most first-time buyers the most, and the part that they prepare for the least. So here's what the board is actually evaluating. It's 3 things. 1, financial stability. Can you comfortably afford the monthly maintenance even if something goes wrong? They're not looking for the minimum qualification. They're looking for comfortable headroom. 2, intent to occupy. Co-op boards strongly prefer owner-occupant. Be ready to explain why this specific building and this specific apartment fit your life. 3, community fit. Will you follow house rules? Will you be a respectful neighbor? Show up to be part of the building community? This is less about personality and more about demonstrating that you understand what co-op living is actually about. The interview typically runs 30 to 45 minutes. For a financially qualified buyer who walks in prepared, it's a formality. But for someone who walks in without having read their own board package, it can go sideways fast. One thing that really works is read the last 2 years of board meeting minutes before you go in. One buyer I know got unanimously approved after mentioning in the interview that she'd already done this. The board noticed. I want to be honest about what this law doesn't do. It sets a timeline. It does not require boards to explain why they said no. The board can still reject you without telling you why, as long as the rejection isn't based on a protected characteristic like race, religion, gender, disability, familial status. They don't have to say why. The law also doesn't address the interview scheduling problem. A board of unpaid volunteers who meet once a month still has to fit your interview into the 45-day window. That coordination might be tight, especially in the summer when boards can invoke a documented recess that pauses the clock during July and August. What the law does fix is the open-ended uncertainty, the disappeared applications, the rate locks is expiring when no one returns a call. Those specific problems are now addressed. If you're thinking about buying a co-op in New York City, here's what I want you to take from this video. The process just got meaningfully more predictable. That's genuinely good news for buyers. But the financial bar has also gotten higher. The liquidity requirements, the DTI ratio, and the board package itself, these are not things that you want to figure out after you're under contract. The buyers who navigate this well are the ones who are going to understand the full picture before they fall in love with an apartment. That's exactly what I do with my clients. We run the numbers, we review the building, we check the financial requirements before you make the offer, so there are no surprises at the worst possible moment. If you want to talk through what this looks like for your specific situation, the link to schedule a call is in the description below. No pressure, no pitch, just 30 minutes with someone who knows the process from the mortgage side. I'm Nicole Hamilton. Subscribe for more content like this. I cover the New York City market for first-time homebuyers every week, as well as other states. And if this video was useful, send it to someone who's thinking about buying a co-op in New York. They need to know these things about how the rules have changed. I'll see you in the next one.